It's not very often you get to speak to an accountant, let alone a property investor who has a property portfolio over $17 million worth. On this session with Jeremy Iannuzzlli, an expert property accountant with over 15 years experience and thousands of clients, he unveils the numbers, everything you need to know to outperform exactly what is going on in the property market. These are the sessions where, so he brings up a spreadsheet that looks at the net yield versus the gross yield. He looks at the numbers based on whether he does a granny flat strategy, a subdivision, and he really goes and looks at the things that are underperforming, and really questions how his investments are performing. These are the types of sessions that you need to look at and watch if you're looking to grow a profitable and scalable property portfolio. Now, there was so much value added from Jeremy and even our co-host, Palisi of Palisi Property. It was a great session, so make sure you tune into this one. Hi everyone, I'm Jeff Miles, and together with Joe Tucker, we've created Australia's largest property Facebook community with over 75,000 property investors. Now, each week we interview top property experts. You get to sing along and be part of that. Let's dive into a session with Jeremy Iannuzzlli, the accountant who helps thousands of clients, and has got 10 years. He's the expert property accountant, been doing it for 15 years, and has a $17 million property portfolio. Let's dive in. What do you guys think about the CPI print today and where interest rates and what the economy, what are we sort of looking like for the next sort of 6 to 12 months? And Steve first, what do you reckon?
I'll give my answer first because mine's a dumb answer. I personally don't care because I can't control it. So anything I can't control, and I'm always buying an investment with a 5-year plus plan. So that's going to change over 5 years. If I can't, it's not like interest rates where you need to have adequate buffers for it. So if it goes up, great for my commercial properties, if I've got CPI aligned with that. If it goes down, I don't make as much, but it's not going to change my decisions now. I'm not going to sit there for 2 years being like, oh, I'll wait for inflation to change. So for me, I'm not an economist. I don't understand the economy. Jeremy is into that. He reads Economy Weekly or whatever the magazines are called. I just buy with the mindset of, is this property going to be in more demand in 10 years' time? Can I hold the costs? What's the worst case scenario? And then go in guns blazing from there. But Jeremy will say something a bit more eloquently than me, I think.
Look, from my perspective, inflation means a very hot market, a very hot economy. People are making a lot of money. There's significant costs involved in potentially building new properties, and that's why we're seeing building approvals come down in some aspects. And yes, interest rates do follow to help cool it. But I'm not actually really concerned with interest rates rising in moderation. I'm actually more concerned with interest rates significantly reducing, especially overnight, because for me, that means we really do have a broken economy, and there might be a significant loss of jobs if interest rates do significantly come down quite quickly. And that's going to actually hurt property prices substantially more, because then you won't have people with the ability to afford to buy properties at a higher price, or even with the ability to rent your particular property because they don't have the income, because they don't have a job. So at the moment, I still think interest rates, even though people might say I'm crazy when I say this, interest rates are cheap. And I can say this because when I first started investing back in 2000 and probably 8 or 9 now, when I think about it, my first interest rate was nearly 9%. And I remember high-fiving and cheering when it came down to 7 as the interest rate started to come down post-GFC. So historically, I know interest rates, the historical numbers started to drag back because we've had a decade of low rates, but we are still in a very cheap interest rate environment compared to where things have been over the last, say, 30 to 40 years. So at the moment, I don't think what we've recently seen on the print is going to change too much of the RBA's decision, but I more look at the job numbers. I'm looking at new jobs being created, and I'm looking at job losses. To me, that's got a bigger factor on the residential and commercial property market, because if people don't have jobs and people can't work and they don't get paid, money doesn't cycle through the economy, and that will trickle across everything as opposed to being concentrated just to one issue.
Would you, Jeremy, ever hold off buying if you saw some numbers that you weren't attracted? Because we've had this chat many times about whether hold cash versus put in assets. Is there any signs where you'd say, "Oh, I'm actually might sit out of the market for a year or two," or would you just pivot and change the opportunities that you're looking at?
Yeah, I think you always got to have the mindset of opportunity. There's always going to be an opportunity in any different market. But in saying that, sometimes doing nothing can be the best decision as well. Sometimes sitting on cash and holding back and waiting for things to happen is not a bad decision. I sometimes will look at areas go up 10 or 15% before I feel comfortable enough to buy into it, because I never try to pick the bottom and I never try to pick the top. I've definitely sold with money on the table, but I've always had a different opportunity to move it into. So I do look at certain things. For me, though, job data is probably the most important. How tight the job economy is or how loose the job economy is. Because in the end, if people don't have jobs, they're not confident, they don't spend, they're not earning money. And as I said, that's a massive ripple effect, more so than, say, interest rates moving. And let's face it, 0.25% interest rate increases. I know it's something and it may hurt some people out there, but it really is a very blunt blade. I'm more worried about interest rates increasing like they did in 2007, just before the Howard-Rudd election, 1%. That was when the RBA had spines on their back and they would move interest rates at 1% and 1.5%. None of this 0.25 that we've seen over the last couple of years.
How do you kind of assess, what metrics are you kind of looking at, Jez, in your investment?
Look, I'm not probably as focused heavily with my heads in the book around data. I'm focusing on areas that I know, focusing on areas that other people know. So very much a populist opinion. So I think that's quite important. I don't try to uncover hidden gems in the middle of whoop whoop. What whoop whoop is for anybody out there, it is the middle of nowhere. So I'm really focusing on just popular suburbs where people have an ideal lifestyle that they want to live in those suburbs, and that's why the Gold Coast has done so well over the last 3-4 years. But if you look at the Gold Coast, the 10 years prior to that, it was probably one of the flattest markets. If anything, it was down as a percentage return, not just on growth but also on rent. So where that's done really well is it's followed that popular formula. What I will say, and it's going to be very controversial, and Steve, I do apologize because it does impact a little bit of what you do, but what I've seen is that this very much self-fulfilling prophecy across many investors who are guided by buyers agents and or property forums like the Oz Property Group. Now, if you guys can really hone and understand where people are moving, you can follow quite early that populist movement, get in and get out, and sometimes make $100,000. A lot of areas in WA, a lot of areas in South Australia, even a lot of areas in Queensland, because I manage so many different buyers agents, I would say nearly 80% of Australia's buyers agents were buying in these condensed areas and creating a significant level of demand. And then all of a sudden, so many other people who weren't using buyers agents were actually getting in a lot later than the buyers agents. And these buyers agents were getting a substantial amount of value for their clients. I actually saw some clients sell during that period of time where things were increasing, and some clients selling at good profits, making 200 grand in 2 years, and then moving that into the next popular suburb. I got one client who's done this the last 5 years, just literally with a buyer's agent, tried to buy in these areas, followed it around and bought and sold in a couple of years' time. And he was making hundreds of thousands of dollars. And in fact, a couple of those purchases and sales that he's done, he's actually sold for a lot more than what the property's value is today, say a year on. So if you can follow that, that's a really good way to hunt some profit and move your money around and try to get some decent value. And that's where, utilizing sometimes professionals early can be fantastic, because they create a market, they create a hype for a lot of other people to come into who aren't following the data, they're just following the populist theory.
Why do you sort of look at selling properties, and when do you look at selling them?
For me, I've always got an opportunity. If there's a better opportunity, and look, regardless of what people might say, and even I've been guilty of going on many podcasts and talking about ways to grow the borrowing capacity or have, almost an endless amount of borrowing capacity. There will be a time where you do tap out. So there needs to be an enrichment, a pivot, a rebalance, a bit of a cleanup of your portfolio where you are buying better quality properties. You're buying properties that meet the needs of what you have now. You're buying properties that might be have better opportunity from a development perspective, better opportunity from a cash flow perspective, or might be an investment which you don't have to spend much time on because it could be an old one you're getting rid of. So for me, if I've seen a property substantially grow in value where the net yield on valuation, net yield meaning what's it's going to give me when it's fully paid off versus the valuation of the property now. And again, I always go back to an example, a property in southeast region of Queensland. I bought it for low 2s. I sold it for high 6s. And the rent at the stage was about $400 a week. For me, I didn't see that particular property, going to go rent of $700-800 a week, like when I bought it for 200,000-ish. So I used that money and I then went and bought a $1 million property with no further capital other than the $50,000 I initially injected into that $200,000 property. So I got my 50 grand back, Jeff and Steve. I got this fictitious amount of profit that someone paid me after tax, which is great. And then I moved that money into a $1 million property, renting for $1,400 a week. So I turned 50 grand buying a $200,000 property, renting for $400 a week, into a $1 million property now renting for $1,400 a week. I increased my denominator, which is the asset portfolio that I had, and I increased the amount of net rental income or gross rental income that I was earning each week. That to me is a progression in the portfolio, which allowed me to have a bigger base where smaller percentage returns actually result in higher gross level of profit and higher gross level of value. This is just a little bit. I like to do this with my own portfolio. So I've picked this particular client's property, which is in the North Brisbane area in the Petrie Basin, and they bought this particular property for $507,000. Overall, it did, when we add interest into account, it did make a $13,796 loss. So it actually cost them money to hold this particular property. Now, I haven't complicated things by adding, what the tax benefit is as an add back, but generally nearly 14 grand was a loss. In that year, they had a valuation being done on that property. So the property val in 1 year increased to $565,000. So they made a $58,000 gain. Yes, it's on paper, but nevertheless a gain. Take the loss into account of $13,796. They made a profit of about 44 grand. That 44 grand, when you take that as an amount, a return over the purchase price itself, it actually provided the client a yield of about 8.79%. So anyone who is holding a property portfolio and you might be losing 23 grand like I was just on the Nowra main property, or you might be losing 5 grand or 10 grand, I really suggest that you get regular valuations of your property, at least on a yearly basis. It can be done through your broker, or you might be able to have a subscription to an RP data or something like that. But getting a valuation yearly, it will help you put things in perspective. I'm losing this amount of money. It's a cost of doing business, but this is now my valuation. So again, just bringing back principles that big companies take into account, and I'll use tech businesses, for example. They will burn through cash, Jeff and Steve, like you would never believe. Absolutely burn through it. Millions, if not tens of millions and $100 million a year. But what they're working for is they're working for a potential sale that may occur in the future, a $1 billion sale. So they look at the $100 million that they lost as a cost of doing business for the sale of a $1 billion potential sale of their tech business, and they've just made $900 million. It's the old Afterpay story where the boys were losing tens of millions, if not hundreds of millions of dollars, and had a cash out of $32 billion on the sale. And I think Box bought that and weren't very happy with the purchase. So do your valuations yearly. Look at your valuations, which is what the property has actually made you as far as a capital gain is concerned, not a sale, of course, less what it's cost you. If those numbers are negative year on year, well, then unfortunately going to have maybe a compounding problem. But if it's costing you a little bit of money to keep and you are seeing the valuations quite strong as they continue to flow through the years of ownership, that hopefully will put things in perspective to think that, well, it's not for nothing. There is a golden goose or an egg there at the very end for me to take or take from a sale perspective.
Jeremy, when you're looking at obviously the net yields, do you ever consider like cash on cash from like the original money you put in versus what you're getting now? I know it doesn't work as well for negatively geared properties, but when you've got positively geared properties, do you look at cash on cash as well, or are you purely looking at net yields?
You do. Cash on cash is a really great methodology, really great calculation to work out what are you actually making based on the money that you've invested in. You can go down that rabbit hole and really start to do that for every asset that you've got. But for me, I try to look and focus on the bigger picture. I don't go too deep into it because I think sometimes you start to look at things and it could be positive or negative or taking you into a position that giving you a false or misrepresentation of the real numbers. I feel looking at things like this is a much better level of return because in the end, it's what's money in your pocket. No one really cares about your cash on cash return. It's just how much money I made from buying my $500,000 property or my $600,000 property. But this is just a little bit of a metric that I use, Steve and Jeff, when I'm deep diving into my property portfolio to work out, should I keep it? And I keep this data over a number of years. And I really then start to look back at it and say, well, the growth has slowed. I'm starting to not make anywhere near the level of return that I'm generating. Is there potentially better assets I can put my money into now?
Why aren't people buying? What is the reasons not to buy in trusts?
Yeah, so there's a number of pros and cons, and I always like to start with the cons because you get the nasty stuff out of the way. Your cost, number one, I like to start off with my take on it. This is my personal opinion for all investors. Your first couple of properties you want to purchase in your own name. Life changes, you have children, you go overseas, you do many different things in life. And I like to say the first couple of properties we purchase, we do it individually. Keeps the costs low, keeps things simple, and it gives you a taste into property investment. Many people start investing into property at a very early age of their career as well, where their income might not be at their peak. So your borrowing capacity will naturally increase as your income increases or you change professions, you might go into business. So you've got to take all those variables into account. But you've gone through your first couple of properties, you're now wanting to start to get really serious about your property investment journey. You've done all the expensive things in life and now it's getting serious with your money. Trusts and companies and all the various different structures involved with purchasing assets, not just properties, but purchasing assets are a really good tool to grow, but they cost money, Jeff. They cost money. They're not cheap to establish and they're not cheap to run. There is more compliance involved from an accounting perspective. There's more time and compliance involved from your own personal perspective. So it's definitely something you want to look through a lens and say, I need to be ready to make this investment to pay these costs. And with that, I'll obviously see a more sophisticated level of investing to come from it. So costs are one of the main reasons. Number two, complexity. They are more complex structure. There's more things involved around it. There's more understanding and knowledge you need to gain on it. You need to make sure that you got the right level of professionals around you to help you manage it. So that's very important, complexity. Number three, there are some indirect costs associated with trusts, and it could be potentially conveyancing, it could be soliciting, could be costs if you exit the deal, and other costs such as land tax as well. So you need to factor in these indirect costs that you get through these more complex structures, more sophisticated structures, and are you prepared and are you aware and knowledgeable about them? So if you've gone through those, that various level of education, you've got a really good professional team around you and you're understanding and aware of the costs associated with it, then it is the right step then to move forward with the more complex structuring. For a lot of Steve's clients, and mutually we share many of them, they've bought their couple of foundation properties and now they're ready to enter into the world of commercial property investment. And structure just goes hand in hand with many commercial property investments for many reasons, such as GST, carrying on an enterprise, and tax minimization. So I do say to everybody, you've got to understand the cons. Trusts and structures are alike, such as companies developing. They're all things that you do as you've really built your foundations. You've got your solid roots in the ground from a property portfolio or an asset portfolio in general, and you're ready to take that next step, that next cost of doing business, that next cost of investment. So they're pretty much the cons that most people need to be aware of. Things like borrowing capacity may come into account, not often, but may come into account depending on legislation and also the compliance of the banks. But in more more times often than not, if you're using the right structure and have the right business plan attached to the portfolio you're looking to build, that's when these sophisticated structures can take you to another level. And that's where you start to look at the pros, I should say. The pros being, the ability to protect your assets, especially if you're in business, the ability to improve your tax position. If under the right structure with the right conditions, you can substantially improve the amount of take-home money after tax from your portfolio. And again, we all know, and it's very well documented now in many people's platforms and podcasts and YouTube videos, that with the right conditions under certain structures and the right banks and the right policies involved, you can have a benefit that comes from borrowing with the right conditions attached to it. So, you don't go into structure early. And I've spoken to many people who are wanting to establish structure on their property number one. And there's very rare circumstances when we as accountants would recommend it. But for the most part, I really say to people, have a taste of property investing. Get a taste of it first. Keep your costs low. Keep the overall situation quite simple, because there's stack loads of time to make your life more complex and make your investment portfolio and journey more complex as well.